This is Paris Hoover, your Patton University online course instructor for this semester. Unit 3, Introduction. The markets are a risky place. Savvy investors learn to balance that risk against potential returns. In order to balance risk and return, investors should ideally aim to achieve diverse investment portfolios. If individuals invest a large portion of their total portfolio in one investment or one particular type of investment, most experts agree that they would be assuming an unacceptably high level of risk. If something were to happen with that one investment industry or other investment type, the investor would be at risk of losing the majority of their invested funds. Financial advisors try to maintain diverse portfolios designed to meet the needs of each client based on the individual's age and other circumstances. Financial analysts utilize the capital asset pricing model along with other financial models to measure relationships between changes in stock prices and changes in stock indices. While the CAPM is widely accepted, it does rely on a variety of basic assumptions. The CAPM revolves around the idea that market risk is the only risk affecting long-term unit returns. Alternative pricing models include the arbitrage pricing theory and the zero beta capital asset pricing model. Investment fund managers have two basic strategies in portfolio construction and management. Managers using the active management strategy try to choose investments that are likely to yield higher returns. In contrast, managers using a passive management strategy tend to buy and hold investments for the duration of the investment period. Investors want to earn as much money as possible on their investments without incurring unreasonable risk. Therefore, they may wish to evaluate the performance of their fund manager. A variety of options and measures are used to evaluate portfolio performance. Evaluating based only on the return would be a simple method, but fails to incorporate the element of risk. More complex methods are available which factor in not only returns, but also time and risk. Investors may wish to analyze the different returns and reward per unit of risk to get a clear picture of the fund manager's performance. In this unit, you will explore all the above and more. Learning objectives. 1. Analyze the merits of international portfolio diversification. 2. Assess the assumptions and approaches of the capital asset pricing model. 3. Evaluate fund performance and management techniques. Continue to Objective 1. Chapter 13, page 276 to 280. Foreign investments and portfolio risk. Investing in the securities of foreign countries has two opposing effects on the risk of a portfolio. Risk is reduced since the foreign investments increase the degree of diversification of a portfolio. On the other hand, there is an additional source of risk to the extent that foreign investments are priced in foreign currencies. The consensus view is that the risk-reducing effects are greater than the risk-enhancement effects. Both of these effects can be interpreted in terms of the Markowitz equation for the measurement of portfolio risk. The risk reduction effect of increased diversification is enhanced by choosing investments in those countries whose stock markets show the lowest correlations with the domestic market. The effects of international diversification on portfolio risk can be illustrated by means of Figure 13.4. Figure 13.4 shows how the risk of a portfolio tends to decline as the number of different stocks in the portfolio increases. The decline is most rapid when the correlation of returns between the stock is low. The correlation is likely to be lower between a domestic and a foreign stock than between two domestic stocks. As a result, the risk of the international portfolio tends to decline faster than the risk of a portfolio containing only domestic stocks. Furthermore, since the returns on the domestic and foreign stock markets will not be perfectly correlated, the lowest achievable risk will be lower for the international portfolio than for the domestic portfolio. Systematic risk for internationally diversified portfolios is lower than systematic risk for domestic portfolios. Whereas the increased diversification provided by foreign investments reduces risk, the acquisition of currency exposure increases it. For the most part, foreign stocks are priced in foreign currencies. If a foreign currency loses value relative to the domestic currency value of the foreign investment will fall. A security may provide high returns in terms of its own currency, but a relative fall in that currency would offset those returns for foreign investors. Exchange rate movements can turn strong profits into heavy losses. A US dollar investment might produce a 10% return in dollar terms, but if the dollar falls 20% against the euro, the result for a European investor is a 10% loss. This can be expressed in terms of the Markowitz formula. The risk of a foreign security held as an investor's only asset is represented by OF in equation 5. In equation 5, OD represents the risk of the security from the point of view of an investor in the foreign country. The currency risk is shown as OC. The correlation between the returns on the security represented by rho DC. It might be noted that the weighting for both the security risk and the currency risk is 1. This is because they both relate to the full value of investment. A numerical example can illustrate some of the implications of equation 5. Suppose that the risk for an investor in a foreign country is 20% PA, and that a UK investor faces a 15% PA exchange rate risk. If this relates to a UK investor buying a US security, the risk for a US investor is 20%, whereas the UK investor faces that risk plus a 15% PA currency risk. Suppose further that there is a zero correlation between the returns on the security for a US investor and the currency movements. Introducing these values into equation 5 gives the combination of a security risk of 20% PA and a currency risk of 15% PA produces a foreign security risk of 20% PA. From the perspective of a well-diversified international portfolio, the contribution of currency risk to total risk depends upon the correlations between the various foreign currencies. If such correlations are low, as appears to be the case, much of the currency risk is removed as a result of diversifying among currencies. It could be argued that not all of the currency risk should be included in the calculation of total risk. For example, the investor's annual expenditure might be partially spent on imported goods. This may give a currency risk which is opposite to that on foreign investments. A rise in the US dollar against the euro will make imports from the United States more expensive for Europeans, but that currency movement enhances investment returns on US securities held by Europeans. One currency exposure offsets the other. To the extent that this happens, the exchange rate exposure of foreign investments can be seen as reducing risk rather than increasing it. In most countries, investors, even institutional investors, invest primarily in their own country. The UK stock equity market is less than 10% of the world market by value, and the UK bond market is about 3% of the world market. However, most UK pension, insurance fund, and unit trust investments are in UK shares and bonds. This has been referred to as home bias, and the behavioral finance concept of familiarity has been used as a possible explanation. It is suggested that investors prefer familiar investments, such as those of their own country, and perceive those familiar investments as both yielding higher prospective returns and providing lower risk. Strong and Shu reported a Merrill Lynch survey in which fund managers from continental Europe predicted that their stock returns would outperform UK, US, and Japanese stock returns. Simultaneously, UK fund managers were forecasting that UK stocks would perform better than the others. Fund managers were optimistic about their domestic stocks relative to foreign stocks in terms of both return and risk. When investors do buy foreign stocks, they buy them in companies that are familiar. These tend to be large and export-oriented companies. The home bias hinders the achievement of the full degree of international diversification required to obtain the greatest possible benefits from international diversification. Please continue reading to page 280. Chapter 14, Capital Market Theory, the Capital Asset Pricing Model. The meaning of beta. The beta of the capital asset pricing model can be interpreted in several ways. One is as the relationship between expected percentage changes in the stock price and percentage changes in the stock index. A beta of 1 indicates that a 1% rise in stock index would be expected to be associated with a 1% rise in the stock price. Likewise, a stock with a beta of 2 would be expected to experience a 2% price rise. A stock with a beta of 0.5 has an expected price rise of 0.05% when the stock index rises by 1%. This view of beta sees it as a measure of market risk. High beta stocks tend to show high price volatility. A second interpretation of beta views it in terms of the characteristic line. The characteristic line relates the excess return of the individual stock to the excess return of the stock index portfolio. A graph is drawn based on a set of points that have excess return on the stock on the vertical axis and the excess return on the market index on the horizontal axis. These points are based on a series of observations from past time periods. Figure 14.1 shows a hypothetical example of a characteristic line. The points marked by an X are observed combinations of excess return on the individual stock and the excess return on the stock index portfolio, where the stock index portfolio is used as a proxy for the market portfolio. The characteristic line is a straight line that provides the best fit to the set observed points. The beta of the stock is the gradient of the characteristic line. The intercept of the characteristic line with the vertical axis is the alpha of the stock. The vertical distances between the characteristic line and the observed points reflect on non-systematic risk, whilst movements along the characteristic line reflect systematic risk. The alpha of a stock is its risk-adjusted excess return. In other words, the amount by which the excess return is above the level justified by beta. In equilibrium, alpha will be 0. Arbitrage will tend to move alpha towards 0. The third interpretation of beta is in terms of covariances and variances, or equivalently in terms of correlations and variances. Omega IM is the covariance between the returns on the individual stock and those on the market portfolio. Omega M squared is the variance of the market portfolio. Rho is the coefficient of correlation between the returns on the individual stock and the returns on the market portfolio. Omega I is the standard deviation of returns on the individual stock, and omega M is the standard deviation of returns on the market portfolio. These three interpretations of beta are different ways of looking at the same thing. They are alternative perspectives on the same measure of systematic risk. The third way of expressing beta can be extended to illustrate the decomposition of the variance of a share into systematic risk and non-systematic risk. The decomposition is shown by the equation below. The variance of the share or portfolio equals systematic risk plus the non-systematic risk. The systematic risk is the risk arising from the tendency for the return on a share to be affected by changes in the return on the market as a whole. The variance of a market is measured by omega M squared, and the extent to which that affects the individual investment is measured by beta I squared. In the stock index, when a stock index is used to represent the market, this is known as the single index model. When dealing with portfolios of shares, non-systematic risk term omega EI squared can be replaced by the following. In this case, omega EI is the standard deviation of share I within the portfolio, and WI is the weight by value of share I in the portfolio. The effect of an expansion in the number of stocks on the portfolio non-systematic risk can be understood by considering the case of equal weighting. If the number of different stocks is n, the weighting of each stock is 1 over n, and WI squared is equal to 1 over n squared. As n increases, 1 over n squared diminishes rapidly, causing non-systematic risk to decline. In the case of actively managed portfolios, such as the majority of mutual funds, another source of risk enters the equation. This is management risk. Management risk is the risk that the portfolio manager produces a relatively poor performance with the effect that the portfolio provides a low rate of return. Exercise 14.1 illustrates the effect of management risk on the total risk of portfolio. Chapter 16, Styles of Portfolio Construction, pages 331 to 367. A portfolio manager faces a number of choices in relation to portfolio construction. In particular, there is the choice between active and passive management. This choice may be made in relation to each of a number of stages of a portfolio construction. Active and passive management. Active portfolio management attempts to outperform the market by choosing investments that are likely to show high returns. The market is often proxied by a broad-based stock index such as the S&P 500 or the FTSE All-Share Index. Active portfolio managers believe that they have the ability to identify the individual securities, sectors, or asset classes that will perform relatively well. In effect, this involves the belief that the fund manager has superior knowledge or understanding that provides a forecasting ability that is better than that of other market participants. Asset prices reflect the market consensus forecast. Active portfolio managers believe that they have the ability to produce forecasts that are better than the market consensus. Active portfolio managers take the view that they can identify situations in which the consensus of other investors is incorrect as to what the price of a security should be. Active fund managers may alternatively or additionally take the view that they can successfully time markets. Market timing is the attempt to identify points where the market is about to rise or about to fall. The fund manager would aim to sell before falls and buy before rises. Market timing is alternatively known as tactical asset allocation. Portfolio managers who imply a passive style do not seek to outperform the market. They operate as if either assets are fairly priced or it is not possible to make profits from any mispricing. Passive management can take one of three forms: a buy and hold strategy, responsive portfolio changes, and index tracking. Passive management. In the buy and hold strategy of passive management, the fund manager buys a portfolio of securities and holds them for the duration of the investment horizon. While the portfolio is held, no attempt is made to change its composition. There may be a dimension of active management in the original construction of the portfolio, but thereafter the portfolio is left unaltered. A second form of passive management involves portfolio changes, but not changes that result from the fund manager taking views that differ from the market consensus. This type of passive management entails adjusting the composition of the portfolio in response to three types of change. The three factors whose variations can lead to alterations in the portfolio are the risk-free interest rate, the consensus view on the risk and return characteristics of the market portfolio, and the degree risk aversion exhibited by the investors on whose behalf the fund is managed. This form of passive fund management entails holding a combination of risk-free investment and a portfolio of risky securities. A rise in the risk-free interest rate would cause an increase in the proportion of the fund held on deposit. A rise in the expected return on the portfolio of securities or a fall in the consensus expectation of risk would cause the fund manager to switch money from deposits into the portfolio of securities. Increased risk aversion on the part of the investors in the fund will lead the manager to increasing deposits as a proportion of the fund. The relative fund proportions of risk-free risky investments within the fund are subject to frequent change, but not as a result of the portfolio manager trying to outperform the market by forecasting asset price movements. Index tracking. A third type of passive management entails the attempt to track the performance of a stock index. Such funds are known as index funds or tracker funds. Index funds give up the possibility of outperforming an index for the security of not underperforming. An index fund aims to replicate the performance of a stock index. The emergence of index funds arose from the observation that actively managed funds fail, on average, to outperform stock indices. This is related to the issue of market efficiency. Active fund management is predicted on the view that portfolio managers can forecast market movements and the performance of individual stocks relative to the market. The efficient market hypothesis is correct. It is not possible to consistently forecast either overall market movements or the relative performance of individual stocks. If this is the case, investors should avoid the transaction and management costs associated with actively managed funds by investing in index funds whose aim is merely to move in line with the stock market. The first issue to resolve is the question of which index to track. This largely depends upon the objectives of the fund manager. For a fund that aims to track the UK market, a fund manager wishing to focus on the shares of large companies may choose the FTSE 100, whereas a fund manager looking for a broader portfolio might choose the FTSE All-Share Index. The choice of index would be influenced by the fact that many fund managers are prevented from buying particular shares. Some countries have regulations that prevent certain shares being acquired by foreign investors. Overseas managers of index funds would choose indices that exclude those shares. Some issues are not fully marketed. For example, parts of the privatization issues may continue to remain in the hands of the government. There are stock indices that include only the marketed component of share issues when weighting shares in the index. Those indices are likely to be ones preferred by the managers of index funds who wish to avoid any liquidity problems arising from the share issues that are only partially available for investors. One advantage of index funds over a buy and hold strategy of passive investment is that the index fund may provide an optimal level of diversification, whereas a buy and hold strategy is less likely to do so. The market portfolio of the capital asset pricing model is the ultimate perfectly diversified portfolio. When using a broad stock index as the benchmark to track, an index fund could be seen as seeking to approximate the market portfolio of the capital asset pricing model. To the extent that this is the case, the capital asset pricing model might be seen as providing a theoretical justification for index funds. One advantage of index funds relative to actively managed funds is that they are more likely to ensure that the portfolio remains well diversified. Actively managed funds, in their attempts to outperform the market, may hold poorly diversified portfolios. For example, they may tilt the portfolio toward particular industries. To the extent that actively managed funds hold inadequately diversified portfolios, they sacrifice part of the risk reduction benefit to diversification. However, these arguments rest on the use of a suitable stock index. Some stock indices fail to provide optimal diversification. For example, in October 2005, the top 10 UK companies accounted for 54% of the FTSE 100 index. And that top 10 was concentrated in just 4 sectors. Even the FTSE All-Share Index, which is broader, was concentrated in 4 sectors: oil and gas, banks, pharmaceuticals, telecoms. Even if a stock index provides a reasonable degree of diversification at a point in time, changes in relative share prices can cause the index to become unbalanced. Cat cited the example of the S&P 500, in which technology and financial services stocks together accounted for about 18% of the index in 1990. By 2000, the combined weighting of those two sectors had risen about 44%. Another advantage of index tracker funds to the individual investor in collective investments is that they avoid management risk. The performance of actively managed funds can, during a period of time, vary considerably. Some will outperform the index and others will underperform it. The variation between the best and the worst can be considerable. For example, over the 10-year period to 1st October 2005, the best performing unit trust, OEIC, in the UK equity sector provided total returns of 346%, whereas the worst performer lost 4%. Over the same period, 3 index tracker funds gained 97%, 97%, and 98%. The FTSE All-Share Index produced 111%, and the average unit trust, OEIC, provided 92%. If the direction and size of the deviations from the index occur by chance, as empirical evidence seems to suggest, the individual investor faces a management risk. The individual investors bear the risk that their chosen funds will be relatively poor performers. By investing in the index tracker funds, they avoid this management risk. Probably the greatest advantage of index funds is that they are much cheaper to run than actively managed funds. For example, many actively managed UK unit trusts in the OEICs have a 6% initial charge and annual 1.5% management charge. and transaction costs around 1% per year. This contrasts with the index tracker funds, which typically have zero initial charge, a 0.5 annual management charge, and a minimal transaction cost. At the time of writing, the cheapest UK index tracker fund had a zero initial charge and a 0.1% annual management charge. A drawback of index funds is that they tend to omit the shares of very small firms. Even broad indices have a cutoff in terms of company size. For example, in the UK, the FTSE All-Share Index covers about 750 stocks. This eliminates more than 1,000 firms whose capitalization is not sufficient. Actively managed funds are able to include any stocks, including those with very small capitalizations. Another drawback is that an index tracker fund will hold disproportionately high amounts of overpriced shares and disproportionately low amounts of underpriced shares. Even if it is accepted, it is not possible to identify mispriced shares or to make profits from identified mispricing. It may still be the case that many shares are mispriced. Stock indices on which index tracking funds are based are normally value-weighted indices. The proportions of stocks in the indices, and hence the index tracking funds, reflect the relative market capitalizations of the respective companies. Since market capitalization is equal to the number of shares in issue multiplied by the share price, overpriced shares will have excessively high capitalizations and underpriced shares will have disproportionately low capitalizations. Index tracking funds will therefore have excessive holdings of overpriced shares and too few underpriced shares. This will be bad for fund performance. This is a problem for the whole of the fund management industry, not just for index tracking funds. If indices are biased towards overpriced shares, it is because the stock market is similarly biased. In turn, the average portfolio will have an overweight holding of overpriced shares. Please continue reading the rest of this chapter.